the winners of tomorrow are made today. And the track record that the winners actually accumulate over the time is something that nobody else will be able to replicate 3 or 4 years down the road. We shortened the time to structure a security from 10 to 12 days to something like 40 minutes. While there is a certain role for blockchain in many aspects, people and clients in particular, they want to have a clearly defined product and they want to have certain services from people like us, asset managers or banks or probably custodians, whom they can trust. We were also, I think, among the first to issue DLT-based securities. I think it's fair to say that Dekas, also in Germany, is one of the leading banks in the area of blockchain technology and financial ecosystem development. We are still in the process of finding the right role for DLT and for tokenization. Where it is right now, it's not so much in need of central bank money. It is probably more in need of commercial bank money. This is something what we are investigating now, and this is also the discussion about stablecoins.
Welcome to the Unchained Culture podcast, the podcast where we explore the transformative power of blockchain technology and its potential to reshape industries. Today we invited Michael Cyrus from Deka, and we explored Deka's blockchain initiatives, their strategic vision for tokenization and how they're shaping the future of institutional adoption in digital assets. That was just a quick summary, but Max, who should listen to this episode and what can they learn from Michael?
The Deka journey is interesting because they've been one of the pioneering institutions in Europe when it comes to tokenization. So their journey dates back to 2016, and they've been extremely active of building out or incubating their own blockchain network specialized in tokenization. They have been building out custody solutions, tokenization platforms, been super active in tokenizing different financial instruments. And the overall theme of this conversation really was about, okay, what did Deka learn throughout these years and what can other institutions learn from their journey? And I think Michael is quite an interesting guy to talk to about this because he's been a man of both worlds. So he was, while being also responsible for all the digital asset activities, he was also responsible for their traditional capital markets business. So he has a good perspective on what both market needs. And it was quite interesting and also challenging to hear all the experiences and sometimes also the frustration. But I think it was also full of promises, and I can see it now like in a better light of where this whole tokenization game is going in the next years.
Very well summarized. And that's also why I'm happy that Deka is part of the Digital Asset Season, Europe's largest educational campaign on exploring the next drivers of institutional adoption and digital assets. So from January to March 2025, and we are already right in the middle of it, we have 8 leading industry partners that are hosting together with us a 10-week immersive series, exploring the most crucial themes shaping the future of digital assets. But enough of the talking. Should we dive into the episode, Max?
Yes, let's go.
Okay, then see you on the other side. Quick disclaimer before we get started. The content of this podcast is for informational and educational purposes only. It is not a recommendation to buy or sell any financial instruments, securities, or cryptocurrencies. All information is provided without warranty, and the views expressed by the hosts or guests are strictly their own opinion, not financial or investment advice. Please note that we or our guests may hold positions in the financial instruments or cryptocurrencies discussed. And now, enjoy the podcast. GM, or a good afternoon on this Friday. We're here together with Michael from Deka. And I want to start with the icebreaker before we go into like the deep dive of today's session. And just looking at your LinkedIn, it's quite interesting that you're leading short-term products, equity finance and FX at Deka, but you're also deeply involved in this whole digital assets topic. And it's an interesting combination, and I'm curious what this role actually comprehends, and maybe you can guide us a little bit into how your day-to-day work looks like.
Yeah, thank you for having me here. Actually, I was just promoted to the head of digital assets at Deka. Yeah? So I think that is a reflection of the fact that I'm relatively involved into the Deka digital asset strategy. And indeed, some of the beginnings date back to 2016 or 17, when we met in my office with a couple of people and looking into the new DLT or blockchain world. And at the time, I said that DLT and blockchain is relevant for banks because we have decentralized financing systems, but crypto is probably not. Yeah? So with regard to my own portfolio, this was probably a poor judgment. But with regard to what we are doing here at the bank, I think there is some relevance to it. And because I'm responsible for lending, at Deka Bank, we also tried to establish a securities lending platform on or based on blockchain. And we solved a couple of problems that are usually associated with DLT technology. So it is decentralized, it is fully transparent, you can actually achieve real-time settlement. But at the same time, we also found out that in order to create a securities lending system, you actually need to also establish a fully fledged financial ecosystem. So you need to have a couple of different people selling securities, people lending securities, people holding securities. And at the time, this proved quite difficult to set up such a network of financial institutions based on DLT. Also at the time, there was no regulatory backing for DLT technology as a whole. And this all changed a couple of years later when we had the Digital Securities Act in Germany. At this time, we were also, I think, among the first to issue DLT-based securities, wholesale banking type securities. And then 1 or 2 years later, we decided to set up Swild, DLT based startup that is tasked with setting up a DLT based network for financial institutions. And then last year, I think we were one of the biggest institutions participating in the ECB trials. So by now, I think it's fair to say that Deka also in Germany is one of the leading banks in the area of blockchain technology and financial ecosystem development.
Mm. You made already the really good pitch, because the next question would have been, okay, can you give us a quick overview of what Deka actually is and where it's positioning itself within the banking system? And I think you've already kind of answered that question. But then leading into the one that comes after it, what is the biggest shift in business models that blockchain enables for banks and asset managers, in your opinion?
Yeah, I think it's still a little bit too early to tell. And I recently had a discussion with some people, and we talked a little bit about what blockchain means for financial institutions. And I think at the beginning, there's always this idea you can cut out a lot of middlemen. So in particular in banking, but also in trading and capital markets, the area where I come from, the idea is usually you have probably 5 traders, and you then have probably 20 to 25 people around them, and they're just looking into what the traders are doing, and they're writing everything into their books and keep the records and ensure that you're compliant, and then they're moving the securities from one place to the other, and all this is, and to a large extent, it probably still is a relatively manual process. And the idea of blockchain, I think in particular at the beginning was, you don't need any of that. And then, for instance, when we set up our Swild network, we actually at the beginning thought everybody who would participate in the network would be keen to operate their own blockchain node. Because at the end, it's about blockchain, right? Everybody should have his own node. Everybody should be fully responsible for the assets within its node. Everybody should have his keys and all these kind of things. And then people said, wait a minute, I'd like to participate on your blockchain network, but can you run the node for me? And I was like, oh, I wasn't expecting this. Yeah. So then we came up with a tenant type structure where we are operating the node, but then like a depot bank, we are servicing certain activities for the people participating in it. And then we thought, okay, that's probably the way how we deal with it. It's very similar to the kind of banking models that we operate today. And then in the end, we had a quite large German corporate. And he even said, well, Michael, that's great. I think we want to do these type of transactions on your DLT technology, but we don't want to have anything to do with it. Yeah, so just give us the money, and do everything you need to do, and then we are fine with it. And this actually, at least to us, showed that while there is a certain role for blockchain in many aspects, and it's, I think, still probably the relevant infrastructure for a decentralized financial network, it's also fair to say that people and clients in particular, they want to have a clearly defined product. And they want to have certain services from people like us, asset managers or banks, or probably custodians, whom they can trust and who can do certain things for them that they are really not interested in doing, because actually their focus is somewhere completely else. And I think this is something that we in banks or in capital markets, we often underestimate. Money and assets are our business. And then it's easy to think that it is also the business of everybody else. And I think that's not the case. Everybody else has something else to focus on. And then how you move your money and where are your assets and is there a corporate action and what kind of interest rates do you have to take care of? These are kind of questions where people probably rightfully say, okay, somebody else whom they can trust should take care of it. And this is actually why I think that we are still in the process of finding the right role for DLT and for tokenization. And I also tend to feel that at the moment, at least in the realm of digital assets, we have not 100% found the super niche that would give rise to a ChatGPT moment where everybody is jumping on the product like crazy, and we have difficulties with the bandwidth of our data connections. I think at the moment we don't have these difficulties.
Yeah, we're already like in the middle of discussing the takeaways and learnings of the last years, but maybe stepping a step back, and because you all make it sound so natural, so taking it for granted that there was this digital Securities Act, and now it was like, okay, we have to somehow develop infrastructure and do our own experiments. But if you look at the broader banking landscape, banks just tend to be a little bit more risk averse and being a little bit more, okay, let's wait and see. Let's have others experiment. If there is value, then we might also, like a couple of years later, join the race. So what was the strategic rationale back then that you thought, okay, it would be great for you to be an early mover?
We had exactly the same kind of discussions. So people said, okay, nobody knows what's going on here. Let's wait. And then the idea is like, and then we buy the winners. And usually we had the discussion. I said, okay, this will just not happen, right? Because the winners of tomorrow are made today. And the track record that the winners actually accumulate over the time is something that nobody else will be able to replicate 3 or 4 years down the road. At least I could not see that. And this is actually why at Deka we took the risk at the time to invest into DLT, because we were convinced that this is a good infrastructure, and also we are coming out of the savings sector, right? And the savings sector is a peculiar animal in Germany, in the sense that it is really a decentralized financial network already. And this is why at the time we said, if DLT is a financial infrastructure for decentralized networks, then there is no better economic financial ecosystem than the savings sector, because that's us. And at the same time, coming out of such a decentralized financial ecosystem, it was also clear we would not be able to dominate any kind of new infrastructure. We are not Google, we are not Amazon, we are also not JP Morgan or else. We are a relatively small bank. So in order to be successful, I think a decentralized infrastructure is actually quite good for us. And this is also why we had some vested interest in shaping the future of financial markets in order to allow also smaller niche players like us with a very clear but also focused business model to thrive in a new world with a new technology. And these were the kind of discussions that we had at the beginning. I think it's now also clear that that many people, or that already some of the banks have dropped out, which I think is also quite a healthy environment. So some are back to, okay, let's look at where the winners are. So the market is already in the process of weeding out and finding some new form, but we are not there yet. I think that's also fair.
And going back to the business model question, and maybe being a little bit more concrete and taking the perspective of looking at the P&L that tokenization could impact from a bank perspective. Is it for you, when you started out, did you think more about, okay, how can we use this technology to drive efficiency and be and save costs? Or do you also foresee a play which is rather increasing like revenue and accessing new markets that were not accessible before?
I think at the beginning we were pretty much talking about cost, and most of our presentations and most of the business cases that we came up with, and all the business plans, they were all about cutting cost. For instance, in securities lending, we were looking into the cost of transferring securities between different partners. Because there are all kinds of different agents involved, there are custodians involved, there are CSDs involved, and of course the banks need to make some movements. So and all this is costing money that is being paid to different agents. And at the time, we came up with the idea that, in particular in the area of cross-border movements, security movements, you should be able to save 30% of the cost, just in the movement of securities. And then actually we had an interesting moment, and this was when we discussed our DLT ventures with some asset managers. And then I told them, listen, we can save all this cost, securities are moving. And he looked at me and said, that might be interesting for you from a capital markets perspective, but I'm an asset manager, I don't give a shit. And I was like, whoa, what are you talking? So, and he said, well, it's very easy. I buy a security, and usually the security stays on my balance sheet until it matures. It doesn't move. And I was like, that's interesting. So while we, again, at capital markets business, it's all about the movement of something. It's all about rebalancing portfolios. But in asset management, it's more like, okay, you buy and hold. Assets are not moving. So the cost savings case that I was making up was something like falling on deaf ears. Now, with digital securities, I think this also changed. Because if you take a look also in asset management into the depository structures, then again, the depository structures are huge, monolithic kind of market structures which cost enormous amounts of money. So for the asset manager, it is more a question, how much money do I pay for just holding my assets in a certain vault with a certain custodian, with a certain CSD or else. He doesn't care so much about the movements, but he does care about the cost of holding his securities. And then again, if you actually introduce something like a fully digitalized asset, then again the idea should be that cost should be coming down quite significantly. And it's not just the cost of holding and not just the deposits of securities. Another part is cash flows. So if all these assets usually have all kind of cash flow characteristics, they pay coupons, they pay dividends, there's corporate actions, splits and all these kind of things. And usually in these silos, there are many people taking care of this, sometimes still by fax, sometimes with emails and else, and this is costing time and money. And then again, but here we are really talking future, if you had the idea that you embed some intelligent smart contracts, and they don't need to be so intelligent, but they need to be smart contracts on top of the assets, then you can start automating a large part of what is being done in a quite manual process today, and that could reduce costs significantly for the financial industry as a whole. So we started with something with a narrow view from a capital markets guys. So then we approached the asset managers, but we still found it's also relevant for them. But as you can see, and as we found out over the years, you have to learn a lot. You have to talk with many people to understand their different viewpoints in order to come up with an infrastructure, with a technology solution that is relevant for them. And I think this is up to today, it's a challenge.
I talked once to your colleague Marion Spielmann, and she mentioned to me that you could also think about your strategy as the vision to somehow cover the whole life cycle of a digital product on chain. So from issuance to custody to lifecycle management and so on. And I know that you've been investing heavily in the last years into making this possible. How far are you along this journey? So what's the timeline for having this whole life cycle being represented on chain?
Yeah, unfortunately, it's still early. So hard to believe. After so many years. We are still early in the process. So what have we achieved? What we have achieved is we are able to have fully digitalized securities. And I think that is already something which is very important. And we also found out, as part of the full digitalization, in particular with respect to all the primary markets, with respect to structuring a security, that has created enormous benefit, or is able to create enormous benefit. As said, many of these things are still happening on documents. You need document paper, people are faxing, there are telephone calls, all these kind of things. We brought everything into the digital realm, and we shortened the time to structure a security from 10 to 12 days to something like 40 minutes or else. And then you can settle in the primary. This means the issuer is selling to the first investors pretty much in real time. So these are benefits which are clearly there. What we then thought is that we need something like cash. So because cash is something you need in order to achieve delivery versus payment. So the idea that the asset and the cash is being transacted at the same time, and this is very important in banking, and usually this is not the case. Also in Europe, the security infrastructure is fragmented in its own right. So we have something like 30 different securities depositories in Europe. But the payment infrastructure, again, is set up in a way that it doesn't have anything to do with the securities infrastructure. And this is something where we thought, okay, if we are able to bring cash on chain, then we will be able to achieve delivery versus payment. And then we can go to the regulator, and in many cases would be able to net certain transactions. And netting usually happens when you have two movements of assets and cash flows. And in some cases you move the asset, let's say in the morning, and then you're waiting for the cash to come in. And the cash is coming in from a different counterparty. And usually you have an expectation that the cash will hit your balance sheet at the end of the day. But actually it did happen in banking that at the end of the day your counterparty was bankrupt and the cash was not coming in. And consequently the regulator said, okay, there is a certain risk. Yeah, and banking is all about risk management. Yeah, and this means you have to reserve capital. There have to be credit limits. You have to reserve liquidity. For all these kind of situations where it's not clear. That by definition the cash and the assets are moving at the same time. And as I said, in Europe, in most of the settings that we have, we can't have such an expectation. And this is actually why cash on chain is so important. We thought we can close this by introducing central bank money. This is actually why we have been quite vocal, in particular with the Bundesbank already for years, to create some kind of wholesale money. They now came up with the ECB trials. I think everybody was quite happy. We've moved something like 1.5 billion or so with 50 to 70 kind of counterparties. So everybody was saying, okay, we ticked the box. This was a success. Now, unfortunately, number one, the ECB has said we only do these trials for 6 months, and then we go back to thinking about it. So this means there's no scalability. People have not really invested into infrastructure. It's still relatively manual, and at the moment it's not even there. But the other part that we learned is also something which is more fundamental. When you come from a repo or sec lending perspective, you are moving billions of money on a day, in a week, during the month. And then you want to have central bank money. So central bank money is money that is coming straight from the central bank onto your ledger. So this means it has no counterparty risk. Because you can't have counterparty risk in the billions or in the hundreds of millions. That would be very expensive. And this is actually why the typical perspective of people in capital markets and wholesale banking is usually we need to have somewhere central bank money. But what we also learned is for a retail client or for a corporate client, that is usually not the perspective they have. They are perfectly fine with holding their money with a bank or with a broker. And they actually know that if the bank is going into financial troubles or the broker is going default, then their bank is at risk. This is why we have all kinds of insurance systems around it. So this is commercial bank money. And what we actually found is that the market, at least where it is right now, is not so much in need of central bank money. It is probably more in need of commercial bank money. Why? Because what we are seeing is that people are creating digital assets in the realm of 1 million, 5 million, 20 million. I think some of the largest issuances are 300 million. These are sizes where you actually are probably happy to have a central bank solution in the back. But actually you can also transact with commercial bank money. And this is something what we are investigating now. And this is also the discussion about stablecoins. So part of what we are looking now is how do we create commercial bank money solutions to put them on the chain with our digital assets. And we can probably talk about some of these stablecoins in a minute. But then the last bit that we are also still lacking is smart contracts. Because the idea in the end would be you have your asset on a chain, you have cash on chain, you are able to do delivery versus payment, and then you have smart contracts. And the smart contracts are blocking the payments for the dividends before they come due, and then they're transmitting that automatically. So you start to program money and smart contracts. And once you have such a closed financial systems ecosystem, this is when I think there is a fair chance to have something like a ChatGPT moment, but not before. And that is part of the issue that we're working on. So you need these three. If you have these three, I think the benefits are very clear to everybody, and you would immediately see that cost structures would collapse, that the banking would become much cheaper than it is today. But you see, it's a huge effort to create digital assets. It's a huge effort to get cash on chain, and then we still have to create derivatives. And this is why, from my perspective, it's like we've done a lot. but we are not there yet.
So just to summarize, I try to comprehend it with as a person who is not operating or who has not been operating in capital markets for a long time. So what you're saying is that the base layer, or the base functionalities like the blockchain network itself, custody technology, maybe also trading, obviously, that's something that's solved. Now it's about bringing commercial money on chain, on scale, so people have this delivery versus payment like efficiencies, and also the back office automations to have them represented or executed in smart contract logic. And if we solve for these two problems, then it's basically like a market adoption type of question, that people have to join the network to increase liquidity, and then liquidity begets liquidity, and then we can scale the system. Is that like a summary correct, or would you
I think
change something?
that was a perfect and much shorter and better summary than what I've said. And I agree that the problem, and you said it very rightly, one of the problems that we currently see is liquidity, right? I think we have been discussing also secondary market liquidity now for quite some time in the market. And I think there was a little bit like an implicit assumption that if you put everything on DLT, because of atomic settlement and real-time transparency, blah, blah, liquidity would just be there. And we also found out as part of the ECB trials, that just is not the case, right? And part of this is still in the market, there are mostly banks operating. Banks like us who are structuring and who are issuing or helping issuers to hit the market. But we still also do not have enough investors in the market. And many of the investors that we lack in an institutional markets are actually institutional investors, so asset managers. And asset managers have very clear ideas of when you actually, from a regulatory perspective, could talk about existing secondary market liquidity. And this is not if Deka Bank actually commits itself and says, okay, I give you prices from 8 to 18 in the evening for the following sizes. That is some sort of market making, but that is still not enough. They want to have more Dekas. And not only more Dekas, in some cases they also want to have MTFs or OTFs, so market trading facilities, small exchanges, where investors and issuers and banks and brokers and market makers can meet. And something like this is still not there yet. And then one last thing, institutional. At the moment, in European capital markets, you are able to hand over your many bonds as a collateral to the central bank. And then you're getting central bank money. And that, to a large extent, has become a little bit of the backbone of probably modern or European and to some extent also American, but in particular European capital markets. It's not a particularly good position to be in, but at the moment the idea is that a large spectrum of the assets can be brought to the central bank, and then you get central bank money for it. And that, by definition, increases secondary market liquidity, and it also improves the spread on the assets. And at the moment, the central bank pretty much said, okay, I don't accept assets that are coming out of a DLT network asset blockchain. Because at the moment they're coming up with arguments like, okay, we would have then to accept certain blockchains, and probably they would be privileged versus other blockchains. So they're still in the process of making up their mind. So, and this is actually why also in the realm of digital assets, we still have to solve a couple of problems. We're working on that, but as I said, we also found out there that that's probably more difficult than we anticipated, put it this way.
So it's still also a regulatory conversation that you're having?
Yeah, and we're going there on different fronts. So one is we try to convince central banks to open their window for central bank cash. So just to continue with the solutions that they have been showing at the ECB trials. But we also try to convince them that, let's say, if you have a corporate bond, which, if delivered through a CSD, is central bank eligible, then actually the same kind of corporate bond issued on a DLT must be ECB eligible as well. And I think these are, this is also just an application of simple fairness rules, so there's nothing special about it. But central banks and regulators, they also have to start moving in order to help us creating this infrastructure. In essence, I think it would be in their own interest, because Europe is a story about fragmented market and about fragmented infrastructure. So coming up with new DLT-based models, which probably at some stage would also start to link into each other, where we would have interoperability. And for instance, when we talk about tokenized assets, I think this is a clear chance that there would be interoperability of different blockchains. So blockchain, at least from my perspective, allows us in Europe to overcome fragmentation, and that should be in the utmost interest of the regulators as well.
A few weeks ago, Christian Lindner, our former German finance minister, unveiled his party's crypto agenda, and among some of these suggestions, there was this idea of placing German government bonds, or Bundesanleihen, for those who are from Germany tuning in, on the blockchain, enabling them to serve as a collateral in financial markets. What is your perspective on that proposal?
That's a good question. Yeah. Now, let me put it this way: bonds are already one of the most liquid asset classes in the world. Probably they are the second most liquid asset class after U.S. Treasuries. And this means, by definition, and there are hardly any settlement fails, by the way. So, and this means the need to bring bonds on DLT is probably not that big, and the efficiency gains you would actually have if you would bring them on a blockchain are also not huge. So in this case, it would be more, if they would do it, they would probably help in the development of the DLT technology. But it would not be something where you would argue that this is now creating hyper liquidity for bonds. Bonds are already at the highest end of liquidity that you can imagine. And this is also why, when we are talking about tokenization and when we are talking about digital assets, then at the moment we are focusing on the less liquid part of the asset spectrum. And this is just because in that part, a technology like DLT would probably achieve the highest efficiency gains. So this is something where you would really change something, because you are making something liquid, which by definition at the moment is totally illiquid. And this is something where you create a real benefit. You could probably bring a Bundesanleihen on a blockchain, and it would be great for any blockchain to have them. And probably there is a link, and there is a link where we talk probably about something like stablecoins and these kind of things. And that would probably change something. But bringing just Bundesanleihen on DLT just for bringing it on DLT, I think that is not creating a whole lot of synergies for the world. If you bring Bundesanleihen, let's say, if you create a small niche to start with, of Bundesanleihen on DLT, and then you say, okay, these Bundesanleihen should of course have the same characteristics. So this means they should be eligible as collateral for the ECB. Then it would become much easier for other DLT assets also to go the same route and say, okay, Bundesbanks, we know how this works with the ECB. Now please accept these collaterals also as as collateral in the ECB. And you would probably also create Bundesanleihen with T0 and probably real-time settlement. And then we can probably also talk about using them for stablecoins, where we would have similar settlement structures. So it's not like, okay, we just move the whole Bundesanleihen market, and now bring that over into DLT. I would not advocate anything like that. But if we would say, okay, we carve out something like 4 or 5 billion, probably 10 billion. And that sounds a lot, but the Bund and the communities in Germany have issued 450 billion last year. So it's not big. So if they carve out something like 5 to 10 billion, put it on onto a blockchain, and then see what kind of markets evolve around that, and help to create a liquidity and a financial ecosystem, then I think this would be very helpful.
I think the counter argument to what you've been saying is looking at what has been successful in the crypto native RWA tokenization space. So real world assets, I know that's a little bit of a misnomer, but just when you look at what has received a little bit of adoption so far, then we could see, okay, it's mainly beyond stablecoins, tokenized money market funds, and it's the traditional asset managers basically replicating their financial products, but on chain and catering to a new segment of buyers, which makes me wonder if, like, considering these different strategies that also an institution like you could pursue, which one would be, like, on a short term, maybe also more promising? Is it really trying to replicate or improve like existing products and services and processes to improve efficiency? Or would it also be, like, with the benefit of hindsight, a good approach to maybe just start building out these tokenized Bundesanleihen, tokenized money market funds, and have them bring on chain that serves as collateral for stablecoins, and then can somehow grow with them in their adoption, or can also be bought by crypto native institutional buyers? What would be, like, now thinking about, okay, with the benefit of hindsight, is that something that you would have loved to pursue more earlier, or are you, like, totally fine with the approach that you've chosen?
I think well, the answer is probably somewhere in between, but I think what is important to have in mind, and people sometimes do not look into that enough, from my perspective at least. The European and the American capital markets are working completely differently, and this is also, if you take a look into the financial market in Europe, it's very much banking dominated. If you take a look into the US market, it traditionally is capital market dominated. And this also means that, for instance, deposits in the US market for a long time have not played such an important role as they still play in Europe. And this also explains why you have these huge money market funds. So you have huge money market funds because people in the US, and actually also many of the retailers, they actually hold money market funds as compared to holding their cash with a bank. And this also is being helped by the US Treasury. Because the US Treasury, and they just had something like 6% deficit, and it's the biggest kind of economy of the world, with a 6% budget deficit, and they're issuing because of the debt ceiling and these kind of things in the ultra short-term area. And they actually have 4.5% or something. So that is actually quite interesting to invest. And institutionally, it is also that there's enormous amounts of short-term amounts of collateral in the market that you can use to feed money market funds. And this is also why you see that the US money market funds are way bigger than anything that we have in Europe. And I think it's probably, I could not put a number on it, but if I take a look into some of the money market funds, of the big money market funds here in Europe, that is nothing in comparison to what is going on in the US. So the yield perspective is much more attractive. There is much more material of the same issuer, which is risk-free. Yeah, and people in the US have long walked away from putting their money into the banks. It's usually sitting in money market funds, and it doesn't make a lot of sense, right? Because let's face it, if you have 4.5%, or probably 4%, 4.5%, yeah, and this is what you're getting in US Treasuries, and you have no counterparty risk because it's backed by US Treasuries. This is very attractive. In Europe, we're talking probably about 2.5%. And then actually, for instance, if you take the Federal Republic of Germany, I think we are usually issuing in the 5 to 7 years. And then it's not just the Federal Republic of Germany, you also have France, you have Belgium, so you have all kinds of different issues with all kinds of different counterparty risks. So this actually makes it a little bit more difficult in Europe to set up these kind of money market funds. And this also explains why tokenization is not such a straightforward thing to do. So I think, and we have been looking into that, that when we, for instance, have let's say some sort of a European stablecoin solution, then we still need to have some yield enhancing products. And this means, in the end, if we have a stable coin, then we also need some sort of a tokenization of a money market fund. So I'm not 100% sure how we structure it, but this is something that is feasible. But then still, if this would be ultra successful, we would still scramble in Germany to get enough short-term paper, let's say government paper, and then this would be at a 2.5% yield. And the yield between Europe and the US is even getting bigger as compared to something like 4.5%. So this makes it also, just from the economic fundamentals, it's also a little bit more difficult for us here in Europe to just replicate what has been done elsewhere. I think in Europe we unfortunately we need to find our own answer, and the answer is probably not to just do one-to-one what the Americans have done very successfully, I have to admit.
Maybe now reflecting on all the statements that you shared in the last 40 minutes, it seems like on a high level it's still all very promising, but it's also super challenging, and we still don't know when it will materialize and in what products, like on a bigger scale. Would that somehow also, what's the takeaway for banks that are tuning in now and that have been following your journey for the last years and who are still thinking about, okay, I've seen Deka get all these licenses in place, I've seen them build out the infrastructure. Do I have to feel FOMO now, or is it still okay for me to wait it out and observe it for a little bit longer?
Well, I think if you were a bank, I would tell you, okay, we want you to be part of the journey, right? But I think it's also fair, and this is also a conclusion from what I said, at least 2025 is a year in transit. We still need a couple of additional infrastructure elements to create a DLT-based infrastructure which is much more efficient and hopefully also at some stage more liquid than what we are seeing today. I do feel that we are not so far away, but I think we will probably not see that 100% coming out this year. But I think we will be seeing a couple of new products and then in probably 2 years. This has probably created something like a ChatGPT moment where then people are feeling FOMO coming out of their ears. But that's probably also me just preaching my own book.
Coming to the end and the last question, actually, looking into 2025, you've already mentioned it's a important and big year, but what is on Deka's roadmap for this year, especially in terms of digital assets? Like, what kind of key milestones are you aiming for?
First we try to solve the conundrum of cash on chain. Yeah, I think this is where we are in concrete talks with other people in the market to create a European solution. I think there has been some discussion also in the DeFi world whether European stablecoins and these kind of things make sense because of MiCA and regulation and these kind of things. I would my answer to this is whatever happens also in the crypto world, and I do think that crypto is important, but whatever happens in the crypto world, there's also a payment structure world for the European economy. And if DLT plays a role, then we need a European stablecoin to facilitate the payment flows that are coming out of the European economy. And this is why stablecoins will play a role, even if for the time being, for a couple of reasons, they will find it difficult or challenging against against the US counterparties. So this is something that we are working on. We are also working on concrete solutions for tokenization of a couple of real-world assets. I think this is also something that we will have achieved by the end of the year, and we're in discussions with a couple of banks to create derivatives on-chain. So that we can live up to what we discussed at the beginning. You have assets, you have cash, and you have derivatives, all on a unified ledger. So the idea could be to have this kind of prototype for a unified ledger by the end of the year. I think that would be successful. And then we would probably see whether people find this so attractive that there could be something like mass adoption in the market.
Cool. Thank you very much. I'm really looking forward just watching your journey from the sideline. Is there, like, last question, how can people, if they're interested to talk about all of these things, like how can they get in touch with you? Is it LinkedIn? Is it an email? Now it's the time to share your contacts.
You can always get in touch with me at Deka, of course, and through savings or else. So if you're talking to people at the savings institutions and ask them for tokenization or blockchain, they will probably also point you to Deka quite often. But if you want to make direct contact, I'm on LinkedIn.
Yes.
And as of recently, I've actually made a lot of contacts, also very interesting contacts in the DeFi community, but also TradFi community, and usually I'm also answering my emails within probably a couple of days. But I'm actually I always try to ensure that I answer all my mails. Still.
Yeah, this is a very good statement to finish up this podcast. Thank you very much for taking the time. It was very insightful, and hope to see you soon. I think we will see each other in London again. But this podcast will come out after that. So thank you very much. And I wish you a wonderful rest of the day.
Thank you.
Thank you. Bye-bye.